Imagine a company that just saw like a massive multi-billion euro drop in its cash reserves in a single quarter.
Right, which is usually a massive red flag.
Exactly. Most people would see a cash pile shrinking by billions and completely panic. But this company's executives are so remarkably confident in their future that they are practically throwing billions of euros right back at their shareholders.
Yeah, they're definitely doubling down.
They really are. And today, we're going to look at a document that proves exactly why. We are cracking open the ASML Q2 2026 Earnings Investor Presentation Script.
Yeah.
And for you, the intellectually curious listener tuning in, this is, well, it's not just some dry corporate update you scroll past on a financial blog.
Oh, absolutely not.
No, this is the ultimate cheat code to understanding the physical backbone of the entire artificial intelligence revolution.
It really is. I mean, when you get past the surface level jargon and look closely at these specific numbers, you aren't just seeing corporate finance. You are looking at the exact mechanical and economic engine that makes this entire global AI boom physically possible.
And that is our mission for this deep dive.
Mm.
We're going to decode how the soaring, just insatiable demands of AI are driving massive financial shifts at one of the world's most critical hardware companies.
We've got a lot of ground to cover.
For sure. We're going to unpack their staggering Q2 2026 numbers and figure out what their roller coaster cash flow actually means for the future of tech. And joining me to decode all of this is our expert guide, someone who can look at a dense spreadsheet of inventory data and see the shifting tectonic plates of the global tech economy.
Glad to be here. This specific earnings script is genuinely one of the most revealing blueprints of the semiconductor industry we've seen in a while.
So before we get into the billions of euros and those wild cash swings, we really have to ground this in reality. We need to understand what is actually being sold here and why the demand is so ferocious.
Right. The why is crucial.
Yeah. The underlying consensus in the industry right now is that the semiconductor market is showing absolute strength, specifically because of the aggressive adoption of AI across almost every application space you can think of. But AI has a huge looming problem, doesn't it?
A massive physical problem, yeah. Power consumption and cost. I mean, as AI models become exponentially more complex, the raw computing power required to train and run them is just skyrocketing.
It requires an astonishing amount of electricity.
It does. We are at a point where major hardware innovations are absolutely required just to keep these massive AI data centers from essentially melting down local power grids.
Or bankrupting the companies trying to run them.
Exactly.
Okay, let's unpack this because this is where ASML comes in.
Yeah.
They are the ones solving this exact power and cost challenge for advanced logic and memory chips. It's like, imagine trying to paint the Mona Lisa, but you are forced to use a thick, permanent marker.
That's a great way to look at it.
Right. That is essentially older chip manufacturing.
Hmm.
You can only make the details so small, which means the chips have to be larger and the electrical signals have to travel further.
And further travel means more resistance.
Yes, and more resistance generates massive amounts of heat. But ASML's lithography machines are like, well, they're like giving that artist a single hair brush.
A very, very expensive brush.
Very true. But they allow chip makers to carve incredibly tiny, dense pathways, billions of microscopic transistors on a piece of silicon the size of your fingernail. Shorter pathways mean less heat, less power consumption, and faster processing. That's how they keep the data centers from melting down.
And that precise mechanism brings us to a crucial technological leap highlighted in this Q2 2026 report. They've announced a major readiness milestone for something called High-NA EUV.
High-NA EUV.
Yeah, it stands for High Numerical Aperture Extreme Ultraviolet Lithography.
Okay, quite the mouthful.
It is a bit technical, but numerical aperture essentially refers to the angle at which the machine can collect and focus light. By increasing that angle, you get an even finer, sharper resolution on the silicon. And this technology has officially reached its first high-volume logic product.
They mentioned a specific collaboration with Intel on this, right?
Yes. And if we connect this to the bigger picture, this milestone reflects a deeply integrated technical collaboration between Intel and ASML. They're actually integrating these high-NA EUV process options directly onto Intel's 18A product layers.
Wait, so by getting this working on the Intel 18A layers, what does that actually change for the industry right now?
Well, by qualifying this highly advanced process, Intel's existing fleet of tools can immediately provide increased output. But it's really about, laying the groundwork for the next decade.
Right.
It guarantees future options for leading edge performance, allowing for that higher transistor density we just talked about. Proving that high-NA EUV can be successfully integrated into commercial manufacturing is a massive de-risking event for the whole industry. It proves the roadmap to smaller, more efficient AI chips is viable.
So the single hairbrush just got even sharper, and they've proven it work on a commercial scale.
Precisely.
Okay, so that's the technological side of the equation. The machines work, the industry desperately needs them, and the next-gen tech is hitting the production line. But building these incredibly precise, high-NA EUV machines isn't cheap,
No, not at all.
which forces ASML into this tricky financial balancing act. When we look at their Q2 financials, we can actually see the cost of this innovation playing out in real time. And here's where it gets really interesting.
Yeah, the financials are highly unusual for this sector.
So in Q2 2026, ASML hit total net sales of 9.3 billion euros. Breaking that down, 6.6 billion came from net systems, so selling the actual physical machines, and 2.8 billion came from installed base management, which is the recurring revenue from servicing and upgrading the machines that are already out there.
Right, but the metric to really watch here is their profitability on those sales. Their gross margin for the quarter stands at an incredibly robust 54.0%.
A 54% gross margin on physical hardware. I want to pause on that because that is the kind of margin you normally only see in software companies with zero physical overhead,
Right.
not a manufacturing company building complex machinery the size of a city bus.
It's an historical anomaly for hardware, honestly, and it points directly to their pricing power. ASML essentially holds a monopoly on extreme ultraviolet lithography.
Because nobody else can build them.
Exactly. No one else on the planet can build these specific machines. So if a customer wants to manufacture leading-edge AI chips, they just have to pay ASML's price.
Wow.
And that pricing power carries all the way down the balance sheet. Their operating margin is 37.1%, reflecting just peak operational efficiency. And ultimately, their net income as a percentage of total net sales is 31.3%.
So they are retaining almost a third of every euro they generate as pure profit.
Yes, which drove basic earnings per share to €7.59 for the quarter.
That is wild. And we can see that demand translating to volume, too. The overall lithography units sold jumped significantly from 79 units in Q1 up to 91 units in Q2.
And the geographic breakdown of where these are shipping is fascinating.
Oh, totally. South Korea took 43% of the sales, which is a slight increase from Q1. Taiwan is right behind at 30%, then China at 14%, and the USA just 9%.
That's a huge disparity.
We will absolutely come back to that geography because it's a critical piece of the global puzzle.
But wait, I'm looking at these unit numbers and, the math isn't mathing for me.
Oh,
Yeah.
where's the disconnect? Okay, so the actual number of EUV units, those ultra-expensive, most advanced machines we talked about, they remain totally flat. They sold 16 EUV units in Q1, and they sold 16 EUV units in Q2.
Right.
So no growth in the physical volume of those specific machines. But then the data shows that EUV's proportion of total sales jumped massively, from 57% of total sales in Q1 to 66% in Q2.
Ah, I see what you're saying.
If the physical units sold were exactly the same, how did the sales percentage jump 9 points? Did they just hike the price on those 16 machines overnight?
You'd think so, but what's fascinating here is that the answer is actually about what they didn't sell.
Oh, really?
Yeah, it's a shift in the underlying proportions of their older technologies. The total number of lithography units went up from 79 to 91, but the composition changed dramatically.
Okay, so the mix of the cheaper machines changed.
Exactly. For example, look at their RFI units. RFI stands for argon fluoride immersion. It's a deep ultraviolet technology that actually uses a layer of water to bend the light and increase resolution. It's a workhorse of the industry, but less advanced than EUV. Sales of those RFI units dropped from 23 down to 17, and because of that drop, RFI's share of total sales shrank from 29% to 23%.
Oh, I see.
Meanwhile, they leaned on even older, cheaper technologies to make up the total volume. KRF units, which use an older krypton fluoride laser, jumped to 30 units. And eyeline systems, which use classic UV light, rose from 9 to 11 units.
Got it. So because they sold fewer of the mid-tier RFI machines and more the absolute cheapest legacy machines, those 16 ultra-expensive EUV machines naturally took up a much larger slice of the total revenue pie, even though the volume didn't change at all.
That's it. And what this really highlights is the massive gravitational cost weight of a single EUV machine. I mean,
Yeah.
just 16 EUV units generate 66% of their entire system revenue for the quarter.
That is staggering.
It perfectly illustrates the shifting technological preference in the market. Customers are willing to spend astronomical sums on the cutting-edge EUV tech to stay competitive in the AI race. That incredibly expensive technology completely anchors ASML's entire revenue structure, allowing the older tech to fluctuate without crashing the top line.
It is genuinely wild that 16 physical objects can completely dominate a multi-billion euro quarter.
Yeah.
Now, those Q2 numbers are spectacular, but building these machines requires looking years ahead, right?
Right.
And the semiconductor equipment market is historically highly cyclical,
Yeah.
goes through massive booms and significant
Oh,
busts.
definitely. You can't just draw a straight line up and to
No.
the right in this industry. I mean, if we look back just one quarter, total sales actually took a dip in Q1 of 2026, dropping to 8.7 billion euros before this Q2 recovery to 9.3 billion.
Right.
Even that incredible gross margin took a slight dip in Q1, slipping to 53.0% before bouncing back to 54.0%.
And looking ahead, the forecast for the first half of 2026 shows total sales estimated at 18.1 billion euros. But the breakdown tells a story. They are forecasting a decrease in the logic segment, which are the chips doing the AI processing, and just a stabilization in the memory segment.
Yeah, the one metric that keeps reliably growing through these dips is the installed base management, servicing the tools they've already sold.
Which makes perfect strategic sense, right?
Absolutely. When chip makers face a dip in consumer demand or when they are trying to manage their own capital expenditures, they will absolutely delay buying a brand new 300 million euro machine.
Yeah, you put off the big purchase.
Exactly. But they will always pay to maintain, upgrade, and squeeze every ounce of performance out of the extremely expensive machines they already own. This recurring revenue acts as a financial shock absorber during the volatile periods of the market cycle.
But the long-term trajectory, that is a completely different story. The end-use trajectory over a multi-year horizon looks like a rocket ship. The logic segment grew from 10.0 billion euros back in 2022 to a projected 16.1 billion euros in 2025.
And memory is growing from 5.5 billion to 8.4 billion over that same span.
Culminating in total 2025 net sales being projected at 32.7 billion euros. But the real shocker is their outlook for the end of 2026.
Oh, yeah.
Q3 of 2026 is projected to be between 11.0 billion and 12.0 billion euros. And the full fiscal year of 2026,
Yeah.
they are projecting total net sales to fall between an astonishing 43 billion and 45 billion euros.
With gross margins expected to hold strong right between 54 and 56%.
To jump from a 32.7 billion projection in 2025 to a 43 to 45 billion projection for 2026. I mean, that is an unprecedented leap in manufacturing volume. And there's a huge clue on their balance sheet that proves they're physically gearing up for this exact explosion in demand right now.
Their inventory.
Their inventories. The data shows that ASML's inventories are steadily, consistently climbing, reaching 11.7 billion euros in Q2 of 2026.
It's a staggering amount of capital to have tied up in supply chains, spare parts, and unfinished machines.
It really is. When I look at that 11.7 billion euro inventory number, I think about a world-class restaurant. It's like a Michelin star chef who is currently spending all their cash stocking their pantry to the ceiling with the most expensive truffles and caviar on earth.
Because they know the VIPs are coming.
Exactly. They are tying up all their money in inventory because they look at the reservation book and they know an absolutely unprecedented wave of VIPs, that 43 to 45 billion full year in 2026 is about to walk through the door. They have to have the parts ready, paid for, and waiting on the shelf to build the machines when the orders hit.
That is the physical reality of a complex supply chain. It takes months, sometimes years, to source the specialized optics, lasers, and mechatronics required for these machines.
Wow.
And this raises an important point about their operational efficiency. By successfully defending their profitability, recovering that 54% margin in Q2, and carefully navigating the dip in the logic segment during the first half of 2026, ASML is proving they can manage this incredibly complex ramp-up.
They're balancing it perfectly.
Yeah, they're front-loading their expenses while demonstrating consistent revenue growth, which is notoriously difficult to pull off in a cyclical market.
Okay, so with billions of euros pouring in from sales and massive 11.7 billion euro inventories being built up, how is ASML actually managing its cash vault? Because building that kind of inventory requires serious cash management, and their cash flow statements are fluctuating wildly.
The quarterly cash flow volatility is definitely extreme.
Let's track this mathematically. Back in Q4 of 2025, they had a massive net inflow from operating activities of over 11.4 billion euros. That led to a net increase in cash of 7.7 billion in a single quarter, pushing their total liquid assets to over 13.3 billion. They're practically swimming in cash.
Right.
But then, the very next quarter, Q1 of 2026, they saw a massive 4.9 billion decrease in cash.
And that brings us to the reality of this most recent quarter, Q2 of 2026. The actual operations of the business, selling and servicing the machines, brought in a net inflow of 1.7 billion euros. So the core business remains highly cash generative on a day-to-day basis.
But despite making that 1.7 billion from operations, their actual bank account balance went down again.
It did.
The net outflows from their investing activities and financing activities led to a total cash decrease of 1.2 billion euros for Q2, leaving them with 7.58 billion in liquid assets at the end of the quarter. So what does this all mean for you?
It seems like a contradiction, right?
Totally. If you were looking at this from the outside, it seems contradictory. The company is printing money, gross margins are at 54%, but the cash pile is rapidly shrinking. Why? It's because they are heavily investing in that massive 43 billion euro future we just talked about, buying up that 11.7 billion in inventory, and crucially, they're aggressively paying back their shareholders.
This is where their shareholder return policy comes into focus, and it is incredibly aggressive. Despite the extreme volatility in their quarter-to-quarter cash flow, ASML is returning massive, consistent amounts of cash to the people who own the stock. They are not hoarding cash out of fear.
No, and the dividend growth alone proves that. If you look at their track record, back in 2017, the annual dividend was just €1.40 per share. By 2025, it had steadily climbed to €7.50 per share.
That's a huge jump.
And in Q2 2026 alone, they paid a final dividend of €2.70, and they've already set the first 2026 interim dividend at €1.88, which is payable on August 5, 2026.
But dividends are just one half of the equation.
Yeah.
We also have to factor in share buybacks. In Q2 of 2026 alone, the company purchased approximately 0.8 million of its own shares.
Oh.
And they spent roughly 1.1 billion euros to do it in a single 3-month window.
1.1 billion euros on buybacks while their total cash position is dropping.
Yes. And if we connect this to the bigger picture, this cumulative cash return strategy, steadily growing dividends paired with massive buybacks, indicates immense confidence from the management team. When a manufacturing company experiences wild swings in cash flow, or when they are facing a temporary dip in a key segment like logic, the instinct is usually to be conservative, to stockpile cash for a rainy day.
Hide under the mattress.
Exactly. But ASML is looking at their 43 to 45 billion euro projection for 2026, and they are saying, we have enough structural profitability to heavily finance our future investments, build our 11 billion euro inventory, and still guarantee massive value to our shareholders.
They are essentially putting their money where their mouth is. I mean, they wouldn't drain their cash reserves to buy back stock if they didn't believe the 45 billion euro tsunami was absolutely guaranteed to hit.
And they are building this financial narrative leading up to a very specific date. Management noted that their next capital markets day is set for June 10th, 2027.
Okay.
That is when they will update their longer-term strategic views, reflecting the market and technology dynamics that have evolved since their last major update.
June 10th, 2027. You can bet the entire semiconductor industry, and frankly, anyone invested in AI will have that circle on their calendars. So let's step back and look at the total picture here. We started this deep dive looking at what seemed like a routine, maybe even dry corporate earnings script for Q2 2026. But what we actually uncovered is the beating heart of the global AI revolution.
We found the intersection of extreme technological complexity and massive financial scale.
We saw how the integration of high NA EUV with Intel 18A is creating the microscopic single-hair brush strokes that keep Moore's law alive, allowing AI to scale without melting down the power grid.
Yep.
We unraveled the math behind how just 16 immensely expensive EUV machines can anchor a multi-billion euro quarter while older technology fluctuates. We saw a company navigating cyclical market dips by strategically hoarding 11.7 billion euros in inventory to prepare for a jaw-dropping 43 to 45 billion full-year forecast.
It's a masterclass in operations.
It really is. And we saw a management team so relentlessly confident in that future that they're returning billions to shareholders, even as their cash flow wildly swings from quarter to quarter.
The physical machinery of the future is being built right now, and the numbers prove it is highly, highly profitable.
So the next time you, the listener, hear about a massive new breakthrough in artificial intelligence, a new language model, a new generative video capability, you now know exactly what is happening behind the scene.
You know the physical machinery.
Exactly. The billions of euros in specialized inventory and the exact 54% profit margins making that breakthrough physically possible. It's not just software code. It's lasers, mirrors, and incredibly savvy financial management.
And as we look toward that 35 billion euro future, this raises an important question for you to consider, drawn straight from the geographic data we discussed earlier.
Right, the geography.
Yeah, we saw that Taiwan and South Korea made up an overwhelming 73% of ASML's total system sales in Q2 2026. Compare that to just 9% for the USA. As ASML charges toward an expected 43 to 45 billion in full-year revenue, you have to wonder, how long can the balance of this vital technological hardware remain so heavily concentrated in just two regions? And, well, how might that global map shift in the years to come?
A massive geopolitical question hiding right there in the quarterly spreadsheet. It just goes to show you should never just scroll past the numbers. Thanks for taking this deep dive with us.